Hello and welcome to the 19th lecture of the course Forex in 3 steps. In this lecture we will talk about the economic cycle, economic indicators and the central bank. Let's start by first talking about the business cycle. The business cycle is a series of stages that the economy repeatedly goes through, including number 1, expansion. Expansion increases in production, employment and income. After the expansion comes next the peak. The peak is the highest point of growth before slowdown. So this is where everything peaks, in production peaks, employment peaks, income peaks, the financial markets peak. Everything reaches a top or a climax. Then after the peak follows recession. Recession is a decline in economic activity. So a recession is identified by a slight decline in production, employment and income. After the recession we reach a trough, which is exactly the opposite of the peak. The trough is the lowest point before recovery begins, and then everything and the economy starts recovery. The recovery phase is the last phase, and it is basically a gradual return of growth after recession or after the trough. And this is how the economy acts and moves throughout the years, throughout the decades and the centuries before. This is always how business moves and the economy moves. So being able to identify which stage we're at will help you make wiser investment decisions and trading decisions. Now let's jump to the central bank. What is a central bank? The central bank issues the currency and sets monetary policies. It also regulates banks and supervises the banking system. It also manages foreign reserves and determines the exchange rate. It also develops electronic payment systems and promotes financial inclusion. So to be specific, the central bank, it monitors economic indicators such as inflation rates, exchange rates, growth rates and GDP, and also balance of payments and foreign reserves. How does it do that? It uses tools and policies to address economic challenges such as monetary policy tools, raising or lowering interest rates, open market operations, buying and selling bonds, changing the required reserve ratio for banks, and also intervening in the currency market to stabilize the currency. Types of economic indicators. We've covered many of the economic indicators in our fundamental analysis lectures, but there are many types of economic indicators, some released weekly, monthly, quarterly, or even annually. Each country's economy relies on certain economic indicators, not all of them. So for example, the US economy relies on the technology and industrial sectors. The German and Japanese economies rely on heavy industries and automobile manufacturing. And the UK economy relies on the financial and banking services sector. Let's dig deeper into the economic indicators, especially if you are more interested in the fundamental analysis and the fundamental aspect of trading, then this is very important. There are many types of indicators as you can see, and let's start slowly from left to right. So we have first housing indicators. Housing indicators include retail sales index and consumer price index, which is also called the CPI. We also have consumption indicators like the consumer price index, which is also the CPI, and retail sales personal consumption expenditures, which is also called the PCE. You will also find energy indices, labor market indicators, production and manufacturing indicators, which are very important as well. These include growth rate indicators, gross domestic product, which is the GDP indicator, and lastly we also have the labor market indicators, which include unemployment rates, employment rates, weekly unemployment benefits, and average hourly wages. The best place to find all of the economic indicators and see the forecasts, see what happened previously, and see everything you need to know about fundamental analysis and the economic events that are upcoming. The best website is Forex Factory. Forexfactory.com is a website that includes all the economic events and indicators that are happening, also gives a nice report about each and every one and how it may affect the market. They also mention the actual, and they also mention the previous rates, and they also mention the forecasted rates. This is the website I personally use for fundamental analysis and for checking the economic indicators, because most of these economic indicators, when they happen, they affect the markets dramatically and can cause volatility and lots of volume on the financial markets. So it is very useful to be able to identify that and know when and how the economic events will act, to be able to react and prevent losses in financial markets. So for example, if you are in an open trade, you have a trade open on, for example, gold, and then unemployment rates come out and there's a vast or big change, then the markets may react in a way that you need to be able to anticipate in order to prevent losses. One more economic event that is very important and economic indicator is inflation. There are several types of inflation. Firstly, price inflation, which is excessive rise in prices. Secondly, income inflation, which is increase in monetary income, for example, wage inflation and profit inflation. Thirdly, we have cost inflation, which is rise in operating costs. And fourth, we have monetary inflation, which is excessive printing of money without real backing. Inflation happens everywhere around the world. Some parts of the world happens to be much higher than other parts, but inflation is a very important economic indicator, and you need to be very aware of how inflation is and what types of changes will happen to inflation if you want to be a successful fundamental analyst and trader overall. Let's talk about the effects of inflation. Inflation is an economic scourge, and its high level is very harmful to any country's economy. The natural target inflation rate for each country is 2%. So higher inflation leads to a significant weakening of the currency, and continued high inflation without intervention leads to economic recession and a severe financial crisis. So it is very dangerous when you have very high inflation and a country that is not trying to solve the high amounts of inflation. Inflation is considered the most important economic indicator that requires monitoring. Another very important economic indicator is interest rates. Interest rates is considered the primary tool for controlling inflation and managing the economy. Studying the impact of interest rates affects the economy drastically, and therefore you need to be well aware of what's happening with a country's interest rates and what the central bank may do with interest rates, especially since, like we said, interest rates are one of the main solutions to inflation. Interest rates also impact financial markets dramatically, because a higher interest rate means that the bank is willing to give more percentage and more gain to those who invest in the bank, and vice versa. So if the central bank decides to increase interest rates, some people investing in the financial markets may opt to exit the financial markets in order to invest in the bank, with the bank, which is much safer, and especially if the interest rate is higher. And that is why you need to monitor this economic indicator very well, because a change here is one of the most things that can affect the financial markets and drop it or increase it very highly. The general effect of interest rates on financial markets. So basically, interest rates are usually linked to investment. If interest rates rise, the cost of investment increases, and if interest rates fall, the cost of investment decreases. You'll also need to know, when does the central bank lower interest rates? The central bank always encourages directing investors towards stocks with very low interest rates. So when a country is experiencing recession or financial crisis, this usually causes a sharp stock decline. And in order to fix that, the central banks and the governments decide to interest rate cut, which makes the stock markets rise back again. Because, like we mentioned, people will not opt to invest in banks, especially when interest rates are cut. So they will take their money from the banks and put it back into the stock markets for a better gain and better return on investment. Rising interest rates lead to lower inflation, thus, interest rates are considered the primary tool to combat inflation, like we mentioned, and rising inflation leads to rising unemployment and reduced spending. It is known that rising inflation weakens the currency's value, but investors act in the opposite way. Investors know well that rising inflation is harmful to the country and that the central bank will raise interest rates in the future. When interest rates rise, the currency strengthens and demand for it increases significantly. Therefore, smart investors act proactively and buy the currency when inflation rises, even before the interest rate is announced. And that is a pro tip right there, to be able to optimize and gain the most out of inflation and interest cuts. That is it for this lecture. See you in the next one.